Welcome to this week's Desk Side Chat. Our featured guest for this week is Greg Luken, founder of Luken Investment Analytics. Greg, appreciate you joining us this week.
Good seeing you, John.
Good to see you as well. We go back a little bit, Greg, and I'd like for you to provide a little bit of a background on yourself, your practice as both an advisor and portfolio manager. Our topic this week specifically is keeping clients invested through market volatility. Obviously, right now, what we've been going through can be quite challenging in many ways, and advisors are implementing a lot of different strategies in order to keep clients invested and engaged. So we'll be jumping into that topic this week, Greg. But if you could provide a little background on yourself beforehand, we'd certainly appreciate it.
Sure. And first of all, thank you for having me on. It's a pleasure to be here. So I started out as a stockbroker at a regional firm that, like many regional firms, doesn't exist anymore. It's now part of Raymond James. But so I got my first registration in the late 88. Ended up with 8 securities registrations, started a broker dealer and RIA in the late 90s, started a pricing platform for non-standardized derivatives that we sold to fixed income trading desks. And we've done some other technology things along the way. It's been a lot of fun. I had so much fun running the broker dealer that in 2003, I regained consciousness and my mind and shut that down and affiliated with SII, one of the MPH broker dealers, before eventually going RIA only. And so we sell research, we sell investment models, we have some proprietary software, we manage a mutual fund, and then we still maintain a small private client division as well.
And actually, I wanted to start there, Greg, as we get into this topic, because I think you have a very interesting story on the individual client side, the retail side, just your frame of mind and how you engage with those clients. And I think that really ties into how you're managing portfolios. So if you could just spend a few minutes, focused on that retail side, and then again, we'll really kind of work into how you've implemented that both on that individual side in your retail practice and then your portfolios as well.
Yeah, sure. So one of the concepts that I got to, I was kind of that, stereotypical, driven, working too much, not taking vacation kind of thing, and kind of had a reassessment, call it an epiphany or blinding shot of the evident, Mr. Obvious popped into my life, and it was I can't be all things to all people, and I wanted to really had a heart to serve and wanted to serve people in the way that I wanted to be served, and realized that I couldn't be all things for all people. So in 2007, in November of 2007, I signed a contract to sell a big chunk of my private client business. And I went from 200 and just under 300 clients down to 17 core clients. So went into 2008 with a fraction of my business. I had someone I could kind of consider a mentor. He still writes a column for one of the industry publications, and somehow word got out. I got a phone call in February of 2008. And he said, a little birdie told me you were planning on doing this. And I said, yeah, that's correct. And he said, it's the worst mistake of your professional career. You'll regret it the rest of your life. And, it was pretty unsettling. And so I went home and told my wife, and we kind of talked through it. And I said, this is not the path that this person, this guy who's got more experience than me and somebody I really look up to, thinks I should take. That I feel very clearly that it's the right path for me. And so we did that, and it's when you make those decisions, you don't have the gift of hindsight, but with hindsight, see, it's really made all the difference. So for us, one of the differentiating factors is that we serve a very limited community of clients, and they know that. And so it does several things to the business model in terms of our marketing spend on the private client side is next to nothing. When the phone rings and somebody says, "Hey, I want to talk to you about managing money," the first question is, "How did you hear about us? Whose friend or family member are you?" And it allows us to really look at the world differently. So if we have all the business we need without developing new business, it really allows us to focus our time, effort, energy, and treasure on things that enhance that client experience for the existing clients. So what kind of firm do I want to be a client of? I want to be a client of that kind of firm, a firm that focuses on taking care of me rather than a firm that is really focused on the next sale. I want a firm that's focused on serving, knocking my socks off in terms of service rather than saying, how do I, chase and skin the next elephant. So I'm not saying that's right. I'm just saying that we felt like that was right for us. And so it was kind of antithetical, but it's worked out really well and for us. And so over the last 5 years, if you look at firms similar size, we're understaffed and under-advisored, but we have tools in place to make that really efficient. And there are a number of benchmarking studies you can look at, and we look at those and go, wow, we're growing at more than twice the industry average, and doing it without a lot of extraneous effort.
And
we've been really fortunate.
Yeah, and you've really carried that mindset over in terms of the advisors that you're serving as far as an exclusive community. It's not trying to be all things to everyone. It's really trying to fine tune the resource, the value that you can deliver and bring. It ends up being a smaller group of advisors as well.
It really does. The thing of it is, we're the sub-advisor for the Smart Diversification Fund, which is a global tactical macro model, top down, and it's done very well, relative to its benchmarks. But the idea was, look, we're not going to be BlackRock. We're not going to be American funds. We're not going to try to be. They can be them. We're going to do what we do well. We're going to stick with our wheelhouse. And, we have one fund. Ultimately, could I see us having more? I could see us having two, but we don't need to do everything. And we just need to do what we do exceptionally well, because average is not enough. That's one of our values. And we believe that we could do it instead of, targeting 5,000 advisors, just really honing in and focusing on those where we can add the most value, those where our message resonate, those whose values resonate with our values. And if we do that and end up with a community of, 50 to 125 advisors, ultimately that exceeds every goal that we have.
And it gives you that ability, like you talked about, to give that higher level of service where you're engaged and in tune with those clients on both sides, the retail side as well as the advisor side. And right now, is an example of a very uncertain time for end clients, where they're going to be looking to their advisor and say, what are we going to be doing? Like, how are we going to be managing our portfolios?
Right.
And some of the historic mentality has been, well, just ride it out. Let's just like kind of sit tight over the long run. Can you share a little bit, Greg? Let's now kind of pivot into your portfolio management strategy and how you've been implementing that with your clients in order to keep them invested.
Sure. And to your point, John, I think it's really a two-pronged approach. One is the portfolio management, and the other piece is how you communicate. So, one of the things that I learned, I didn't invent this. I came across research years ago, and anecdotally, it seemed to bear it out. And that is frequency over duration. The frequency of communication seems to be much more important than the duration of the communication. So, and if you think about this, John, you and I can relate to it. We, uh, have relationships with, when you have a spouse. If you think about, hey, you're away on business, I'm away on business. It's much more important for, if I'm gone for a week, for me to call and speak for a couple minutes every day, as opposed to waiting to the end of the week and spending 3 hours. It's those relationships are relationships of humans are cultivated by frequency of contact. So we do it with short videos. We try to keep them 60 seconds or less in length. We have a studio in our office, and which is where I'm sitting. So that helps. That way, if we have the same message we want to communicate to everyone or to a large segment, it's easy to record it 60 seconds, edit it, and in 20 minutes we've recorded it and sent it out. The other thing is making sure that we have a framework to understand volatility, and I think part of that is framing that up, maybe on the front end, or maybe as the client experience goes along. If you have clients that have been with you for a long time, this kind of market may be ho-hum. But if they're new clients, it may be, hey, I just came over to you, and how do I deal with this? So one of the things that we've discovered in our research is we refer to it as the Pareto portfolio principle. And most people have heard of that 80-20 rule or the Pareto principle. What we discovered is that whether you're looking back, to 2007, 1987, or 1907, the same principle holds true. And that is, markets tend to have periods of time where they make money, capital creation time or new money time. And then they have these really long periods where they decline and recover and decline and recover. And what we found was that almost any period of time you look at that's longer than 3 years, you end up with this approximately 80-20 distribution. And that means that, put it in client terms. And this is one of the things that we talk to clients about, 80-20. So over the course of 10 years, over the course of a decade, the reality is you'll probably spend about 80% of your time going sideways, declining and getting back to even. And you'll spend about 2 years actually making money out of that 10-year period. So if we know that when we go into it, and we talk about that Pareto principle. And so when we get into markets like this, we can have that conversation with clients and they go, oh yeah, I know, 80-20. Yeah. And so it becomes part of their mindset part of their, part of us helping them be better investors to understand that if you have equities as any part of your portfolio, you are not going to make money 100% of the time. And that when that doesn't happen, it's not something that's unexpected. It's just a natural occurrence. So from a framing or a language standpoint, we have found that to be very helpful. Frequency over duration from a communication standpoint, and then from an actual activity standpoint, the human brain craves activity in stressful times. So when portfolios decline and we have that stress, that mental stress, people want to see that something has been done. And, our process does take that into account. So, people are able to see whether they're invested in the fund or in our private client side. They see that they haven't declined as much as the market has. They see that there were changes made, and they're not wholesale changes, but they see that those changes were made and there is a rationale behind it, and we can communicate that. And that helps from that behavioral finance standpoint of, if I know you're doing something and I know it's proactive, and then I can stay engaged in a program, and I see, oh, I'm down, but I'm not down as severely as the market. And you've framed it up, you've communicated with me ahead of time that this is something that I should expect. This is naturally a naturally occurring event. And it's not, what difference will this make 20 years from now? Well, we're proactively making sure that mathematically on the portfolio, a downturn doesn't have as much impact, but also understanding that there is no holy grail. There's no silver bullet. There's no, hey, I'm going to make money every single day unless I put it in a savings account. And then I'm, not even keeping with inflation. So I'd say those are probably the biggest factors there in terms of how we're addressing it with the portfolio, how we're communicating it with frequency, and how we've set up a framework to understand what's going on. And frankly, I think the upside of a down market for financial advisors that are proactively staying in front of their clients, that's where the relationships are made. That's what puts the patina on a relationship. It's easy for things to be okay when everything's going up, and how we behave during down markets really determine our ultimate success, not only as advisors but also as investors.
And along the lines of your portfolio management style, we typically will see the extremes, either a straight strategic type portfolio, maybe rebalancing, or extremely tactical portfolio. And I would say you're trying to find a happy middle ground. Is that fair to say in terms of how you're managing portfolios, Greg? Not really really trying to define your own path, as opposed to throwing in with either of those extremes.
Right. So we think part of diversification is diversification of strategy. So our private client side accounts do have there is a strategic core, and then we have the active management around that. For the Smart Diversification Fund, there is no strategic core, because we know that whether you're at an RIA or whether you're using SAM or SWIM or MWP, you can get those strategic components really, really inexpensively. So why should we try to duplicate that when, again, we're not trying to be BlackRock. We're not trying to be, Russell. You can get those good components from a lot of different places. We're just going to focus on, our wheelhouse. And, fortunately, if you think about that 80-20 rule, is it okay if I go back to that for a second,
Yeah,
John?
please do. Yeah.
Yeah. So if you look at the international or global space, about 41% of the time has been spent declining. About 44% of the time has been spent recovering from that decline. So about 85% of the time in that global space has been spent declining and recovering. Only 15% of the time has been spent making new money. And so our fund has been able to increase that new money time, that making money time, by about 75% for clients. So there is a differential there. But I think it's really, call it hubris, to say that it's always, this strategy is always going to be the best, right? Because any of us who have been around and been in the ring for a while and gotten a few bloody noses understand that that's not the case. And so that's why in client portfolios, we blend the strategic with that dynamic. But in our fund, it's all dynamic. And it's that's what we do for clients. I will say that here, all of our team, we eat our own cooking. So what we do, the active piece for clients, everybody here does that in their own accounts as well. So there's a high level of conviction in what we do. And again, we're not trying to do that for 5,000 financial advisors. We're just looking for, those relationships with the ones that really want that differentiating factor.
And I love your frequency over duration. Keep it simple, and it sounds like your clients are almost spelling back to you. They understand how you're managing. So when it comes to times like these, their mindset has already been set, that they know that they're going to be in this 80-20. This is going to be part of that time. We're either going to be declining or recovering. In terms of your retail side, Greg, do you change up your process or your communication at all with clients? Maybe when it does come to times like this, where it's maybe a little, there's even more fear, there's even more volatility, or is it something where you're just keeping that same process, the frequency over duration, regardless of the market environment?
Yeah, and great question, John. And in times like this, we actually step it up. We do our standard protocol or format is to send an email every 2 weeks or twice a month. And at least one of those contains a video. It is maybe half the time, probably less than half the time, me. And, the rest of the time it's somebody else on the team delivering the message. In times like this, we do make, the team makes proactive outgoing calls. It was funny, last week I answered our director of operations line, and she had made a number of outgoing calls, and somebody called back, and I said, yeah, I know. We call them update calls, and there's a format we use for those. And this person called back and said, you know what, we've been working together for 27 years. I know we're down less than the market, and I know we're down, but you've never steered us wrong in 27 years. So yeah, I'm just going to go back to living life unless there's something I need to do. I'm like, no, we're all good. But the idea with what we frame as update calls, in addition to those emails that go out, phone calls, which I'm glad to give you just kind of an outline of what that looks like if that is of interest.
Yeah, please do.
Yeah. So one of the things we learned was that if it's someone other than me, particularly, that the first thing that needs to be said is who they are and that things are fine. Because the question was, well, why is somebody else? And it's especially important if advisors have small teams, right? And so if their admin or sales associate or junior partner or advisor is calling, it's like, well, why is this person calling? John, why is this person calling me instead of you? And hey, this is Steve. I'm calling here with John's firm and everything's fine. I'm calling for 3 reasons. And it could be 2 or whatever. And one might be, I've got a quick market update on what we're doing and why, if you want to hear it. And number 2, there may be something administrative, but number 3, the most important is there anything on your mind or anything I can do to make your day better or make your week go easier? And then we just listen. And if they want an update, then we have 2 or 3 bullet points. You may notice that there's a little larger cash than usual in your portfolio, or ultra short-term bonds, and it's because here's what we're seeing and here's what our indicators are telling us, and that's to help keep you a little safer. And we'll get that deployed when it looks like things are better. The updates are really simple. We try to keep it, when we make update calls, our mandate is whether you're leaving a message or talking to them, if they have no questions, we complete them in less than 30 seconds. So we're not trying to go into a lot of detail unless they want it. We're not trying to create an obligation in their life. If we call and leave a message, hey, feel free to call me back, but don't feel obligated. And yeah, I'm not worried about the market. I know you guys got it, whatever. So it's not trying to impose something on the client. It's being there to serve them. And then if they do want a market update, that we try to keep that really to we try to keep it to 4th grade language. Keeping in mind that a lot of people that we work with are, they're transplant surgeons. They're people who've owned businesses. We have a Yale-trained physician. I mean, these are not people who have trouble with difficult concepts, but it's not what they want to do every day. And so we just try to keep it simple, high level, and just a couple of talking points that they can walk away going, oh, we're keeping things safer because of this. Oh, we're deploying money because, inflation is 3 times higher in the US than it is in emerging markets. And so that's why we have some money in emerging markets, because it's way down and inflation's lower. They're not real, we're not going into a full-blown research report. And that's part of our brand, is that we keep those things simple and high level. And, if people want to go into it, I mean, we are quantitative, so we're not getting real into the fundamental piece of it. We have indicators, and we see something, say, hey, there is an 84% probability of at least a 3% decline based on this indicator. Clients, we find by and large, advisors sometimes want to know that, clients don't. Just give them something simple. We think, the risk is high. It's probably because of this. And here's the action we took. Pretty simple, straightforward.
I love that, because from a behavioral finance standpoint, keeping it simple, rather than just puking, here's a, very robust, market analysis and all the things that we're doing. And you see so many people who confuse the messaging to the clients, and the clients are like, even, highly educated clients might be, more concerned, more nervous than they would have otherwise been, where I just love that philosophy of let's keep it really, and then you can always go into more detail, right? When the clients are looking for it and need it, but starting at that high level, that makes a lot of sense in my mind. Greg, you're part of our group. We have you listed in our resource library and as a thought leader. So advisors can reach out to you as part of our community. If anyone is watching this outside of the community, what's the best way for folks to get in touch with you?
Sure. My email address is greg@lukenanalytics.com, or the web address is lukenanalytics.com, or and you can email us through there, or phone number is 615-550-5570, and my direct extension is 111.
Awesome. Like I said in the beginning, Greg, we're likely going to have you step back up again down the road if you'd be willing to do so. I think you have a lot of great insight to share with us. We're going to cut off the one-on-one portion. We'll open it up now for any members who want to engage in the backstage portion of this meeting. Greg, thank you so much for joining us this week. Really appreciate it.
Thank you so much, John. Love what you're doing.